Hello all, this is Akshana Menon from PMS Bazaar. So along with me, we have Mr. Madanagopal Ramu, who is a head equities fund manager at Sundaram Alternates with over 15 years of experience in Indian financial markets. He currently manages an asset under management of 4,000 crores in PMS and AIF platforms at Sundaram Alternates. So in today's video, we're going to have a talk on the quarterly update, which is just over by Q1 of 2023. So without any delay, let me ask you the first question, sir. So what was your overview on previous quarter and how do you feel the market has responded?
Good morning, Akshana, and thanks PMS Bazaar for hosting us. So it was a fantastic quarter. End of March, most of the companies delivered in line with what we expected, and there were fewer surprises as well. Interesting part is many of the companies, almost if you go by strategy level, almost more than 50% of our holdings saw earnings upgrade last quarter, and many of the holdings in terms of number of stocks, we saw almost 70% of our companies see a earnings upgrade sort of scenario. Broadly, if you look at, we majorly invest into four major themes: the financial inclusiveness theme, the consumer discretionary theme, manufacturing, and then the digital theme. If you broadly break the results into these four themes, the financial inclusiveness theme, we have invested into retail private banks as well as the NBFCs. Retail private banks on the NBFCs both delivered very strong loan growth, supported by the broad credit growth that is happening in the country itself, as well as what happened is the NIM compression that the market was fearing, the margin compression that the market was fearing generally for banks as well as for NBFCs came as a surprise. Much more on the NBFC side, we saw that the positive surprise was very high because of the sufficient support the NBFCs got from banks, particularly PSU banks in terms of funding. So that was a pleasant surprise. So in our holdings, we saw most of the private banks deliver in line numbers, and most of the NBFCs or small banks deliver slight surprise also to the expectation. More so, the provisioning numbers for the banking system is sort of coming down. Even in this quarter, in the current Q1 quarter of FY24, also we are seeing the NPA numbers are continuing to come down, as well as the provision numbers are continuing to come down vis-a-vis last year same quarter. So these are the tailwinds that are helping the banking system to deliver, and particularly the holdings that we have, which have superior loan growth as well as profitability and continue to kind of deliver in line with expectation. Second, on the consumer discretionary side, there was a lot of fear that inflation will hit the consumption. Consumption has been hurting, inflation has been hurting the rural consumption, and we have almost no exposure in the rural consumption side or any sector which are exposed in terms of growth or dependent on growth on the rural consumption. Our predominant investment is into urban consumption themes, into retail segments, organized retail, into QSR, and into the consumer durable space. And what we found is most of our companies that we hold, like Titan, Trent in the retail segment, delivered in line numbers or slightly better than what we expected. And in case of QSRs, adjusted for some one-offs, we still saw the core numbers being in line with expectation. So not a major kind of impact that we saw due to inflation on these segments. If you look at the other holdings that we have in the consumption space, we have exposures in healthcare. And in the healthcare space, we continue to see improvement in the ARPOB number and margins number, which is helping the healthcare companies to deliver better. And we have some hospitals exposure here in this space. So in the consumption side, also it was in line with expectation. In the manufacturing side, we have exposure in chemicals and building materials, and also some auto ancillaries. The chemical companies, specialty chemical companies per se, the talk of the town at this point of time, primarily because global agrochemical is going through a headwind, and inventory pile up globally is creating cause of concern for earnings. But we have been continuously reiterating that we are not into companies which are selling directly. We are into companies which are supplying to somebody, which are major beneficiaries of getting projects because of the China plus one story, which is not just now, for the last 4 or 5 years. The industry getting impacted due to inventory cycle had a marginal impact last quarter. Even in this quarter, we see there is a marginal impact for most of the companies that we have invested into. It's probably next 2 quarters we might see some bit of a slowdown, but I don't think it will impact in a big way the companies that we own. From a 3-year perspective, still feel that they will continue to get projects and the earnings growth will continue to be surprising. So that is on the manufacturing chemical side earnings perspective. So last quarter was a phenomenal quarter for most of the chemical companies that we own in our portfolio, as against other chemical companies in India which have suffered because of the compression and spread, as well as the demand being weak due to the end user markets being weak. So again, a very big differentiation between what stocks that we have picked compared to what generally being perceived in the market. We have building materials in the manufacturing side, which is both a consumption as well as a building material sort of a play. Astral Poly and Asian Paint, both these companies delivered good numbers. Asian Paint surprised on the margin front, which will continue even in this year. We feel the growth continued to be impressive and the commentary seemed to be impressive. And Astral Poly, after 2-3 quarters of impact due to low falling prices in PVC, Q4 saw a turnaround. I think the turnaround will continue for the remaining period as well. So these are some areas where the earnings surprise came, and there was an upgrade that happened in the overall scenario. On the digital side, we have Zomato and Nykaa. Both delivered in line numbers. Zomato's guidance on the profitability was very encouraging, and this is one stock where we have a very non-consistent sort of a holding. We bet on the profitability improvement story, and that is playing out. I would say slightly better than what even we expected. So that's on the. So broadly, what we are saying is most of the companies delivered in line expectation, and 50% plus companies delivered a beat to the expectation, marginal beat between 5 to 10% sort of an beat. We are therefore seeing that the total earnings growth of the portfolios are anywhere between 20-25%, depending on which portfolio that we are talking about, which is better than what the index delivered. Index delivered, I think, closer to 12% sort of a growth. So almost a 8% beat over the Nifty broader index growth is what we saw. And majority of the Nifty earnings growth also contributed by auto and banking. And if you exclude that, the Nifty earnings growth was in single digit. So compared to that, our non-banking exposures have all done much better. So that's what we are bringing on the table. The earnings growth is giving us a lot of confidence, and the guidance from the management also giving us a lot of confidence that FY24 can also be better.
Yeah, thank you, sir. And even markets are also surprising us by being in continuous green. So I just want, and also to be very precise, even most of your portfolios like Voyager or Self or SISOP, Racing Stars, most of them have given better returns at the benchmark. So if you could just elaborate on their investment philosophy and process that, what contributed to the performance of their, performance the previous quarter.
So what if you look at the way we invest, we keep it very simple. We try to take certain long-term trends calls, basically looking at what is happening at the broader macro level and economy level. We try to take certain long-term themes as a trends, and then we try to select the right companies within those themes. This is what we do. Okay. Broadly, if you look at these themes, don't change every quarter. Probably we might make mistake in the stock also, but the themes generally remain the same if you look at the way we approach our investments. And what has happened in the last quarter is most of these themes, despite getting challenged by the inflation, high interest rate scenario, our bet was the companies that we have selected within these themes have a potential to continuously deliver on the earnings growth, primarily because they have a good balance sheet, they have a good growth opportunity, and all these companies are investing back into the business the cash that they generate, and they are not just giving dividends. Therefore, the earnings visibility has always been much higher. There have been certain one-offs related to a few of the companies which impacted the earnings for these companies last year, and therefore that impacted our the stock price and also the returns for a very short period. But in Q4, what happened? We kept continuously saying that these are short-term impacts, and by within 2-3 quarters, things will change, and that's what happened in Q4. We saw that once the one-off sort of impacts went away from the numbers, the core earnings started coming back, and that is what helped suddenly almost every company in the portfolio across strategies have been in green in the last quarter. Have been in the green. Almost like we have a universe of 35 stock investments. Almost, I think, 33, 34 stocks out of this 35 were in green. There are few stocks where we had a negative impact and we exited out of these companies, say 3 months back, which continued to underperform also in this quarter. There were 3 stocks we came out of. Otherwise, I think predominantly most of the other holdings that we have, they continue to deliver. That is where the stock selection comes into picture.
Yes.
Broadly, what we so we continue to see our long-term themes playing, because the long-term themes are based on next decadal opportunity, not on next 1 or 2 years opportunity. Broadly, if you see, India is a $3.5 trillion economy right now, and we expect it to double in the next 8-year time period. But this new $3.5 trillion will not be driven, or contributors to growth of this $3.5 trillion will be very different from the traditional sectors which have contributed the first $3.5 trillion. So the themes that we have, the financial inclusiveness theme, the consumer discretionary theme, manufacturing theme, as well as the digital theme, all these 4 themes, the players that will benefit will be very different from the players who did well in the first set of. Some of them will continue. Some of the large cap companies which have become large in the banking will continue to deliver stable growth. But what we feel is that there are a lot of opportunity in the mid and small cap space, because most of these trends play on the mid and small cap space. So those trends don't change every quarter. They will continue to be. If there are any stocks that we have taken wrong, we will change it. But predominantly, we feel that the themes that we selected and the stocks that we selected within the theme have the ability to deliver a 20% earnings growth. And when people see, when that has continued to happen, you cannot underperform for a very long period of time, because the earnings growth itself will take care of the stocks to recover. We just need a very favorable market, because inflation, high interest rate is always counter to the growth that we are playing. So what we are playing is a growth at a reasonable price as a style. And this style gets impacted when there is a very high inflation scenario, because growth is questioned for the companies. But we felt that inflation had a less impact on most of the companies that we own in our portfolio, despite our earnings growth expectation is very strong on these companies. But that is now getting negated with the inflation slowing down in India, as well as the RBI taking a pause. So I think that played both the earnings as well as the macros turned favorable to the stocks that we own. And that is what resulted in almost 95% of the stocks that we hold delivering a positive returns in the last quarter.
Yeah. Thank you, sir. But when you just spoke about, the returns and all, you were mentioned about the exit thing, that you exit from the 2 stocks that from the previous quarter. So if you could just elaborate on your exit strategy, or what are the features or characteristics that look into from exiting in a strategy? You could elaborate on that.
So the last 3 to 6 months exits are very different from what we did in the last year in exits. Last year, beginning of the year, we made a lot of exits because valuations became very stiff. We exited even from some of the companies like Dixon Technologies, which has been a phenomenal alpha creator for us, almost 10 times. We bought this company when the consensus did not bet on India manufacturing story. So we betted much ahead of the consensus in this, and we booked some profit because we thought the valuations are now factoring in growth numbers, which are going to be very difficult to come through. And also we are not comfortable with the kind of valuation that are being thrown for a company for the kind of margin and ROC that the Dixon delivers. But when we bought, the valuations were much more comfortable to say. But now the valuations have gone up, as well as the earnings projections that are being talked about has also gone up. We also made the similar exits in IT companies last year, primarily because we thought that global slowdown will impact IT companies and hence downgrade will happen. That is what we are seeing now happening, right? We are zero position in IT companies last quarter. So that also helped us with the kind of volatility that IT sector is going through. Despite being in the index, we feel that another 2-3 quarters we will have to wait and watch what is happening in IT companies from that perspective. So that is on the that are the these were the exits that we did last year. But last two quarters we observed that some of the holdings that we had an earnings impact also, and the earnings impact is getting much more meaningful, either because of competition or because of rural slowdown. One of the stocks that we had an exposure to rural slowdown. So the rural slowdown, which impacts all the FMCG companies, also impacted the stock. And also we had a stock in the pharma space, which is again getting impacted due to competition being very severe there. So what we learned from those three ideas is, one is however big the opportunity is, but if the competition is too high, then I think we need to be realistic on our expectation of what a management can do in a very short period. Second, if the rural slowdown is very imminent, then I think it hurts everyone who's part of the ecosystem. So that also is impacted. So we got out of those names, and those names are continuing to struggle in terms of earnings growth. And replace that by, we added some NBFCs. As I said, the impact of NBFCs due to rate cycle was not so high as it was feared. And now we don't, if not immediately, next year interest rate cycle will start coming down, right? So in that period, NBFCs will again benefit because NBFCs have a fixed book. So this cycle has been a best cycle for NBFCs, in my opinion, because growth was good and they did not get impacted on the margin side when the rate increase happened, primarily because the PSUs were able to support them at a much better rate because of sufficient liquidity at the PSU banks levels. And now that the rate cycle has peaked out, if you wait for 3-4 quarters and then when the rates start coming down, then you'll get the benefit of margin expansion again, because these are fixed books. So that is giving us confidence to increase our exposures to NBFCs or small finance banks, which are in the fixed book sort of a space. So that's the change that we have done. And we have also increased our weights on the manufacturing side, particularly on capital goods space. Capital goods have seen a massive rally, and valuations are very, very high. In the past, a lot of times, I have been a capital goods analyst throughout my career, and it was a very difficult cycle to predict because of the way COVID impacted, capacity utilization changed, and then India regained. But we have taken a conscious decision to add some capital goods, but being very careful about valuations, because valuations for some of the companies are multi-year high and don't give any confidence, or no margin of safety at all is there. If you see any period of small slowdown, which in our opinion is possible given the global slowdown that we are seeing, then there is nothing left on the table. So therefore, we are entering some of these ideas, but we are being very, very careful about it. We have added Cummins and TD Power System. Valuations are comfortable in both these names, and also the Cummins participates in all the PLA sort of capex announcements that are being announced. Not a direct player; he doesn't directly benefit out of it. But any plant that comes in India in electronics or chemical or in ethanol or in data centers, whatever has to do with the PLA schemes, all these plants will have a Cummins genset. All this will have a genset, and the Cummins has a large market share in that space. So that's the reason that we added Cummins in that space, and TDPS, which is seeing a good cyclical turnaround. So these are the changes that we have made to the portfolio.
Yeah, and of course, when you spoke about the change in the portfolio, you also mentioned about the sectors. Of course, with your answer, I could understand that you're quite bullish on the NBFC sector, and you're quite underweight on ITs now. So yeah, if you want to add more to this point, what are the other sectors like Sundaram is bullish upon, and Sundaram is now quite not underweight on a few sectors apart from ITs. In any sectors that Sundaram feels that he should give more weightage for some sectors and less weightage for some sectors?
Again, as I said, the 4 themes that we have laid out, these are all looking at the next decade's opportunity, and those don't change continuously. If you look at between those 4 themes, we are probably very bullish on the IT theme from a long-term perspective, but from next 2-3 quarters, we have probably get a better entry price because of the COVID cycle, the growth that happened in IT sector, there is a bit, still we see the IT sector trading at a higher multiple than the pre-COVID level, but earnings visibility is not so great for the next 1 year. So let's wait and watch and see if we get opportunity. But we'll be very careful on whom we want to add. We want to pay any investment that will happen globally. In India, we do not have a direct beneficiaries of these. You have to invest in companies which are working with this companies which are beneficiaries of AI globally. So we are doing a lot of work. We have some stocks, but these are extremely costly at this point of time. So we need to be careful about the timing and the price of entry. So that is on the IT sector. But otherwise, we have sufficiently invested into the other three themes. We have almost fully utilized our exposure possibility in financials. Insurance is a space where there is a lot of negativity that was there last year, and this first quarter numbers were decent, I would say. But first quarter is a very small quarter for the overall year for the insurance company. So we have to wait and see how it pans out in the remaining period. But that's within the financial space, that's a space where we can see some bit of a value sort of playing out this year, turnaround sort of playing this year. In the consumption space, I think people are still not making a full allocation to the consumer discretionary companies. If inflation will come down in India and these companies start talking little positive, we expect not just the earnings growth upgrade, also we might see a sufficient amount of interest to come back in this space, and we still feel there is a gap in the allocation may not increase for consumption, but between the FMCG and the consumer discretionary, long-term trend is the allocation will increase more towards consumer discretionary. So that got impacted in the last 2-3 years due to COVID and subsequently due to war and all this noise, beef and inflation related to it. But we think that will start happening from 23 onwards. More migration, value migration will happen towards consumer discretionary, assuming that inflation will cool off considerably in the next 2-3 year time period. So that is where we see value migration can happen. Within financial space, I think value migration can happen more so towards some of the small companies that are growing. There, the valuation is not higher compared to the pre-COVID level. So they are at a discount. And these small companies are benefiting from unorganized to organized shift in borrowing. And particularly in 6 states in India, where the per capita income is very high, and also the businesses to which these companies are the borrowers to whom they are lending, despite without formal proof of income, we have seen them coming back very strongly post-COVID and paying back all the dues. So which gives us confidence of the NBFCs that we have in our portfolio, like Home First Finance or Five Star Finance. These companies have shown a tremendous ability to bounce back post-COVID without diluting their growth ambitions. And we feel the growth opportunity here is huge, and some bit of value migration that can happen in that space as well. So these are areas where I think a lot of people have invested heavily into capital goods. So we are also there. But I think in the manufacturing space, most of the ideas that we own, as well as what the market is heavily bullish on, valuations are very high. So you may not probably see a very big jump in valuation there. But if you get the earnings growth right, that is suffice to deliver the required earnings, the required returns to the investors in these companies. So that's how I would broadly say. So in terms of allocation, I think market can pay a little more attention to the financial NBFC space, particularly mid and small cap ones. And in the consumption space, I think market have to get on with this inflation not impacting the consumption in the urban side, and start looking at some of these consumer discretionary names.
Yeah, yes, absolutely, sir. And one more thing is like market volatility and economic landscape changes is something which is very common in our industry, where the market is very unstable. So, with this market being not predictable, so what are the risk mitigations taken by Sundaram Alternates to overcome these things?
See, compared to the macro uncertainty that we entered 2022 post the war, the macro uncertainties become much more difficult to handle with. And also on top of it, we were still in the interest rate hike cycle. Compared that to the current year, the interest rate hike cycle has probably come to an end, at least globally. probably one more, but I think even that is still debatable. And so that scenario is also gone. And India, particularly in a sweet spot, we can avoid any rate increase from here also. So we feel that macro wise on the interest rate hike cycle, inflation cycle, 23 is much better than 2022, and therefore I think for equities it is a better year in my opinion. And one leg of that only got exhibited in the last 3 months. Uh, and I think the market rallied a little more faster than what you would have expected, but still, I think we were not surprised, and we have been talking about it for the last 3 months. That given the kind of macro uncertainties getting macro uncertainties getting behind us, we were expecting a market rally, and particularly when the market touched 17,000 and all, it was getting into a very comfortable valuation zone also. So 15 to 20% growth was possible within next 18 months to 24 months sort of a period. And most of it got delivered in the 3 months time period. That is how markets will behave. So for anybody who is thinking that they will shift to the market when market improves, I think they will always find it difficult to time. That's why we asked the investors to not to take that extreme call of, and we found the redemptions were very high in March, which was very painful to see that they were exiting at the point when the valuations were so comfortable for particularly the stocks that we hold. And now within 2-3 months, we saw almost a 15 to 20% jump in most of the stocks. So I think investors have to be a little patient. And investors, they come in with a 4-year, 5-year view, but they get perturbed within a year looking at what is happening in the market. And we generally say that we run a portfolio which is very different from the benchmark. And for our ideas to play, we definitely need at least 3 years. Generally, what we have observed is when we make changes to our portfolio, first year not the ideal year to, but right now market is looking at what happens in the next quarter or a quarter after. So we don't play momentum. So therefore, the changes that we make, we take at least a year view or a 2-year view. When we are taking those changes, it might take time for it to reflect in the investors' portfolio. So we try to handle the investors, but some investors are they look at the market and the kind of momentum-driven stocks that are running through, and they get excited about it. But I think broadly, the kind of the recommendation that we'll do as a fund manager to the investors is that when we make changes, when we buy stocks, we take at least a not less than a 2-year view, 5-year view in those stocks. But so when you come in, just give us that time for our ideas to play out. And then definitely we are not in the gang who plays the momentum. So don't expect that we buy a stock that run up in the next 2 weeks, 3 weeks time period. We are not, and it's not our capability also. Our capability is do deep research, take the long-term call, and then see what is missed out by the price at this point of time, and see wherever value is there, and then enter into those stocks. So that I think as the macros ease, as we are talking about from here also, I think these will play out very nicely, and investors can see the benefit of it in terms of alpha in their portfolios.
Yeah, absolutely, sir. And one thing that from this, session, I could understand about the previous month's quarter happenings and also how Sundaram has reacted to that, to the market. Thank you for giving us a very brief answer on that. And coming on to the last question of the session is that what is your outlook on your upcoming quarters? Like we have 3 more quarters to go in this financial year. So what is your outlook for these all 3 quarters? And do you find any change in the portfolio that you are having? Do you expect any changes in the portfolio?
Obviously, the first point on the macro side, I think the global slowdown will be the major risk. There is an expectation of a slowdown, but the slowdown is still not happening. And probably at some point you will see a sharp slowdown. But how long the slowdown will last is a question mark, right? My sense is the slowdown may not last for a longer period. So within a year's time, inflation, when it comes down, again, you will see a bounce back in the themes and the things. So from that perspective, I think market, if they underprice too much, anything in the short-term perspective, we will like to buy those names and then hold it for 2-3 years to make money. So globally, that is what we see. From an India perspective, I think things are much better than what you would have expected to be. Hopefully, the momentum should continue on the economic growth front. Manufacturing is on a much better footing right now compared to pre-COVID level. Services are continuing to do well. Therefore, India's growth story around 6% looks very much doable. If anything comes which disturbs this growth, that's when you need to be careful about. But otherwise, I think so far we don't see any risk to the call that we have taken that India will grow at 6% real GDP, 10% nominal GDP, and then the sectors that will drive this growth, bet on those. I think that continues, and we don't see a need for any change. In the next remaining 3 quarters also, the portfolio level, we still feel that there is an earnings upgrade potential in few of the stocks that we own that will, and the portfolio can deliver a 20% plus sort of an earnings growth, most of the portfolios that we have. And that should take care of the return generation process. Wherever we see valuations getting too much than what we expect, we'll make those changes or trim the positions. But broadly, we are fine with what stocks we own, and we hold on to it. We feel that some 3-4 changes can happen, but not majority of the portfolio will remain the same as we go forward.
Yeah, perfect, sir. Thank you for that. Thank you for a very brief answer. And this answers most of the questions for the investors, and they might have some doubts. So people who are listening to it, people are seeing it, will have a clear idea on that as well. So thank you for that very brief answer. Thank you for taking out time for our investors to enlighten us on the previous month or previous quarter happenings. Thank you, sir.
Thank you, Akshara. Thanks, PMS Bazaar, for hosting us. Thank you so much.